In this chapter, we go through equity securities and debt investments. These can get a little tricky, so we're going to take you step by step through these to show you how to account for them and, of course, some of the journal entries that go along with that. First, let's talk about equity securities. The degree to which one corporation, who we call the investor, acquires the interest in the common stock of another corporation, which we call the investee, determines the accounting treatment for how we record this investment. So if the investor acquires less than 20%, we account for this under the fair value method. If you hold somewhere between 20% to 50%, then we account for it using the equity method. And finally, if you hold more than 50%, then we're going to show consolidated financial statements. The accounting for these three classifications is a little different, so we're going to go through some points about each of the differences in this recording. First, let's go over fair value method. Remember, fair value is less than 20%, so the investor has little influence over the investee. So when they acquire it, equities are recorded at cost. The net income is earned by the investor when cash dividends are declared. And the net unrealized gains and losses related to the changes in the fair value are with debits and credits to the unrealized holding gain or loss, they're going to be recorded to that account, and then offset to a fair value adjustment account. And we'll show you what that looks like. So that's your fair value method. Under the equity method, remember equity method is 20 to 50%. And so that shows that the investor has some significant influence over the investee. So under the equity method, the investment's carrying amount is periodically increased or decreased by the investor's proportionate share of earnings or losses of the investee and decreased by all the cash dividends received by the investor from the investee. And again, we'll show you what all of that looks like. So some important things to note is when it's acquired, equity securities are again recorded at cost. The net income or loss from the investee is adjusted by the investor's proportionate share with debits and credits to the equity investment account. And the investment income lost account. So every time there's net income or loss, our equity investment is changing in proportionate based on how much we own of that investee. Finally, if we have dividends, these dividends decrease the investor's investment carrying value with a debit to cash and a credit to equity investment. And again, if you're a journal entry person, a lot of this will make more sense once we show you how to do a couple. And finally, if we have more than 50%, then we use consolidated financial statements because this is showing they have a controlling interest. We don't really get into that in this class. The subject of when and how to prepare these consolidated financial statements is discussed extensively in Advanced Accounting or Accounting 253 here at Harper. The other portion of this chapter talks about debt securities. So let's go through the different categories of debt securities. It's based on what we plan to do with it, how we identify that, and then the accounting for that based on the category. So the first category is held to maturity. What we're going to do with that, or how we identify that's held to maturity, we have a positive intent. Oops, spelled that wrong. Yeah. We have a positive intent and ability to hold this security to maturity. If we are holding it to maturity, we record that at amortized cost. Another category is a trading security. We identify trading securities as being bought and held primarily for sale in the near term. So this is kind of like they want to make some quick money. They're buying something just to sell it once they make some money off of it. This is recorded at fair value. And the last category is available for sale. And this is basically the kind of the catch-all. It's saying it's not held to maturity or trading. Basically, it's kind of the catch-all category. For those, we record those also at fair value. With these debt securities, we have to remember how to account for the effective interest method. The effective interest method is used for debt securities and applied to bond investments just like we have done in the previous chapters. We will practice some of these journal entries in the homework below just to kind of remind you how it's done. So let's do some of these homework problems. This first one, their companies purchased 12% bonds having a maturity value of $300,000. They bought them for $322,744, and they have a 10% yield. So they want us to provide some of the journal entries for this transaction. The first one, A, they want us to record the bond purchase. We just record the debt investment. We're recording that at cost, which is 3. And then we have our cash, same amount. Whoop. Not sure what happened there. That should say cash. Under B, B is saying that prepare the journal entries to record the interest revenue and recognize the fair value for 2020. So first let's talk about the interest revenue and how to calculate interest revenue and interest receivable. So the interest receivable is going to be based on the maturity value or the face value and the bond rate, which is $36,000. But that's the interest receivable. That's the amount of cash that they will be paying. The interest revenue that they're going to record is going to be based on the fair value, the $322,744, times that yield rate, which is 32,274. So then we can record interest revenue as a credit and then the difference is going to go to your debt investment, decreasing that value of the investment, kind of amortizing that until it gets all the way down to the $300,000 amount. So the difference in this journal entry to get those debits to equal the credits is 3725.56. So that there's going to show you again the journal entry just to record the interest. We need to do this piece to find out how to record that fair value for 2021 because that debt investment is decreasing and we have to take into account that decrease in the debt investment before we adjust to the fair value. So let's take a look at this in C. C, they want you to prepare that journal entry to record the recognition of the fair value in 2021. The fair value in 2021, oh, I'm still on B actually. First we have to do the fair value for 2020. We haven't done that part yet. So let's do that part first. But again, we have to adjust for that debt investment. So we have to get our actual value first. 322,744 minus the 3725.56. And that's going to equal 319,018.88. Now we're going to compare that to the 2020 fair value. 320,500 minus the 319,018 is going to be equal to 1,481.12. So to record the recognition of fair value, so this is still part B, the second part, we're going to debit that fair value. Debit the fair value adjustment for that 1,481.12. And the credit to that is the unrealized holding gain or loss. It's the same amount. So now when we go through and calculate the interest for the next year, which they don't want, but they do want the recognition of the fair value for 2021, and we have to see how much we're going to decrease our debt investment by to calculate that fair value adjustment. So we're going to start off with our fair value. So this is part C. And again, we're multiplying that by the yield to figure out the interest revenue. 331.9. Let's see, 31. If I can do my math, 901.88. So that's my interest revenue, right? The amount I pay is $36,000. So my difference is going to be 4098. So when I take the value I have, subtract the 4098, it's going to come to an amortized cost of $314,920.77. Now I can look and see, compare it to my fair value from my amortized cost is 314. This is my amortized cost I just figured out. I'm going to compare that to my fair value, which in 2021 was 309. That's giving me a difference of a loss of 5920.77. But remember, I just recorded a gain already. That gain was 148,112 in the previous year. So to get my loss to actually show that amount, I have to record a fair value adjustment of $7,401.89. When I do this, again, that journal entry doesn't change, but what changes is because now I'm having to show a loss for that amount. That means I have to debit my unrealized holding gain or loss. Again, for that full 7,000 amount, and credit the fair value adjustment. This brings my security down to that fair value. It's a lot, I understand. If you need to take a break, go through this one more time. I would pause the video, maybe try it yourself, and then come back and try some of these test questions that relate to how this would be presented in a multiple choice format. Alright, so let's look at some of these. So on January 3rd, they acquire $500,000 of Harper Company's 10-year, 10% bonds at 532.090, which yield 9%. They want to know the interest revenue that would be recognized in 2020 related to these bonds. So remember, we're going to find that interest revenue using interest revenue. You might want to write yourself a note. Uses the yield and the fair value. So I would take the 532,090 times that by the 9%, and I would get 47,888 and 10 cents. So the answer would be C. But just for the sake of showing you what this looks like, maybe we would debit interest expense for the 50,000. Interest receivable, sorry. Credit my interest revenue for the 47,888, and then that difference, remember, is going to go to debt investment, which would decrease the value of that investment, amortizing it down. So another way this same problem might be presented is saying, what is the amount credited to debt investment in 2021 related to these bonds of the fair value at the end of 2021 is 525. So using that same information, we know that we currently had a fair value of 32,090. We have to adjust for this adjustment to debt investment we just made. We would take all of that and times it by the yield, that's going to give me my 2021 interest revenue. So that's what we're trying to find, is our 2021 adjustment. So when I go ahead and make that journal entry to record interest, my interest receivable is going to be at, again, 50,000. Too many zeros. My interest revenue is going to be at 47,698, showing a debt investment decrease of 2,302. All right, one last one we'll walk through. This one, again, based on the same type of information, but in this one they want the gain for fair value adjustment was recorded in 2020 of 1,250, and what's the adjustment made in 2021 if the fair value is 525. So we've already done a lot of the work for this. My original fair value is 532,090. We're adjusting it for each of those adjustments made during the interest. So we're currently at 527,676. We're going to compare that to the 525, right? Therefore, we're showing a loss, 2,676 as a loss, right? But remember, we've already recognized, if we, based on this problem, that they recorded a gain of 250 in previous years. So if we want to show this true loss, we also have to adjust for that previous gain. So I'm going to add that in to get down to the loss I want. So the answer should be, let me see, a debit to the unrealized holding loss, because it's a loss. That would be the debit for 3926, and the credit would be to the fair value adjustment. So the one that matches that is C. So remember, a loss is a debit to that unrealized holding gain or loss, a credit to fair value. So hopefully that helps. If you've got questions while you're going through this, please don't hesitate to contact me.